once we get to hard carbon taxes, we'll start to see a lot more transparency in terms of earnings and valuations as well.
Hello, I'm Noelle Lim on ASEAN Speaks by Maybank IBG. The Straits Times Index, or STI, has gone up 5% year to date. Maybank believes the Singapore market is in a sweet spot as the country reopens and lives with COVID as an endemic instead of pursuing a zero-COVID policy. Is the Singapore market a haven now for investors who want to earn a reasonable return without the uncertainties of the US and Chinese markets? And as Singapore companies report that they want to become net zero in emissions, how should we factor in decarbonisation costs in their valuations? I speak to Thilan Wickramasinghe, our head of research in Singapore. Thilan, let's start by firstly understanding why did the Singapore market chronically underperform global equities since the global financial crisis?
If you take Singapore, it's been a very value-heavy market and a very cyclical market. Post-global financial crisis, if you really look at it, most of the funds were flowing to growth stocks because money was cheap. Also, Singapore lacks a fairly large hinterland, which, say, a market like Hong Kong has with China, so that was a lot more attractive. So I think that's probably why you saw Singapore underperforming some of these markets.
I suppose also Singaporean investors, they have more options and are probably investing in the US markets as well as in Hong Kong, where they see more upside, especially in the tech stocks.
Yes and no. When you look at our Maybank clients' trading patterns, we do see funds flowing to Hong Kong, the US, as well as some of the regional markets as well. Now, a lot of these markets represent growth, while, as I said, Singapore is much more value, old world oriented sectors. So, and there are much more banks, industrials, property oriented sectors. So I think for the longest period of time, the demand was more for growth sectors.
And now interests appear to be rotating back to value stocks in Singapore, and that's something you noted in your report. And why is that the case?
I think we are in the midst of regulators battling historic inflation. So there is this fear of monetary tightening. We are having forecasts of 4, 5, 6 rate hikes coming through. So this has increased the cost of risk significantly. So growth stocks, which promise profitability at some point in the future, they look better when the cost of risk is low. Now, I think what investors are looking for is more certainty. They want to have more certainty in profits. They want to have more certainty in delivery and execution, and at a cheaper valuation. And I think that's what's driving the PE premiums on the value stocks more.
In terms of ESG, you've noted that Singapore tends to display lower ESG risks compared to Sustainalytics, their global coverage. It's also the lowest compared to the key ASEAN markets like Thailand, Indonesia, Philippines, and also Malaysia for the top 30 stocks by market cap. When sustainable investing become even more mainstream, how might this benefit the Singaporean market or the STI in the long term?
Sustainable investing is already mainstream in my view. But I think if you look at the market in Singapore, it is dominated surprisingly by high emission sectors. You have the banks, which have very high scope 3 emissions. You have industrials, which have high scope 1, scope 2. But what you're also seeing is a major transition towards decarbonization. Business strategies are being changed, particularly in the last few years, to incorporate sustainability. So that's actually bringing the overall risk of emissions and sustainability a lot lower than some of the other comparables regionally. If you take the banks, for instance, they have green lending targets. Property companies are investing only in green buildings. We have Keppel and Sembcorp, which are some of the world's largest rig builders for the oil industry, transitioning to green energy. So I think these are all increasing the investability angle from a sustainability point of view for Singapore. So I think as more and more funds track sustainability, Singapore will have a higher rating.
At this point, would you say there is enough visibility on the decarbonisation costs that will be incurred by companies to scale down or to exit less environmentally friendly businesses, especially those in the energy sector?
I wouldn't say so. I mean, I think that it's still very much up for debate, and I think there is still a lack of clarity in terms of what the actual costs are. But I think we are moving in the right direction in terms of carbon taxes. The budget for 2022 in Singapore, we are looking at higher carbon taxes being introduced as a new measure. So I think that will actually start to be one of the key differentiators. Once you start to see these higher taxes being introduced, that will actually impact profitability of the higher polluters. And that will actually have impact on valuations as well. I think right now we are factoring in more from a value-driven perspective rather than hard numbers perspective. We do screens in terms of how companies stack up on the E and the S and the G, and then we put a value screen on top of that. So I think once we get to hard carbon taxes, we'll start to see a lot more transparency in terms of earnings and valuations as well.
Would you say that the Singapore market right now does offer shelter to investors who want to earn a reasonable return and not have to bear with the higher volatility of the US and Chinese markets?
Absolutely. I think, Singapore has been sitting in the corner for quite a few years, but I think now it's in a sweet spot in what we call the 3 Rs, rising rates, reopening, as well as restructuring. The rising interest rates will actually help a lot of the Singapore sectors, particularly the banks, which are about 40% of the index, as well as sectors like consumer as well as industrial. And as one of the highest vaccinated countries in the world, Singapore should be one of the first COVID endemic countries in the region. And that will obviously help with the reopening story and a lot of the reopening companies within Singapore. And finally, the restructuring story, which is gaining a lot of momentum, particularly from the angle of incorporating sustainability into strategies, but also to become more relevant to Singapore's growth, as well as to the new economy sectors that are coming through. So I think all of these three combined should drive higher investment ratings for Singapore as we go forward this year.
So at this point, based on what we know so far, what are your top 3 stock picks?
We actually have top 10 picks, not just 3, depending on what investors want. So, I think, the 3 main criteria, I think, are stocks that are geared to higher rates, geared to a reopening as well as restructuring. So our top 10 picks are Bumitama Agri, CICT, Comfort Delgro, DBS, Franken, OCBC, Singtel, Thai Bev, UOB, and Wilmar.
All right. Thank you so much for your insights.
Thank you.
Thilan Wickramasinghe, Head of Research in Singapore, for the report on the Singapore market endemic playbook. Speak to your trading rep or go to Market Insights on the Maybank Trade app. I'm Noelle Lim on ASEAN Speaks by Maybank IBG.